last week?
I'm going to call the meeting to order at 7 o'clock. We do have a quorum, although we have, you see here, we have our advisories. It looks like we have a number that ends in 292 and a number that ends in 036. Could you guys just identify yourselves?
Yeah, it's
292.
Webster.
Okay,
Sorry, go ahead.
292 is Bob Maglio from Webster. Sorry about that.
sure.
Yeah, and 6036 is Bob LaBrew.
Okay, thanks. And do we have a recording secretary besides Amy? No?
Sabo's supposed to be on.
We are also recording the meeting, so if she can't join contemporaneously, she can do it afterwards.
Okay. All right then, so we have a quorum, and I would now entertain a motion to approval of the regular meeting minutes of October 19, 2021.
I move that we approve the minutes as written.
Second, Fran Neal.
And it's the first and a second. Any discussion on that? Okay, all in favor?
Aye.
Opposed? None opposed. Now I entertain an approval of the minutes for the special meeting of November 16, 2021.
I move that we accept the minutes as written for that meeting as well.
I will second as well.
Any discussion? Okay, all in favor?
Aye.
Aye.
Opposed? Unopposed? Okay, so moved. We're on to, actually, I have a added agenda item. I'd like somebody to make a motion to add an agenda item. Amy, were you able to send that out to everybody?
I did not.
Oh,
I don't think. Did I send you guys the letter from Milliman from Kai?
No.
They gave us our budget indications for next year.
Why are you smiling?
we'll share it, and I'll add that. We'll add that as an agenda item. So could I have a motion to add the Millman actuarial evaluation for the pension plan and trust?
I move that we add the Milliman pension plan, whatever you said, to the current agenda.
Yeah, and we'll add it under, I guess we'll add it under 4C communication.
I will second Ed's motion.
I'll be quiet next time. You can have the first one.
No, I like to follow you. It's okay. You go out front, see what happens. I'll follow.
Great, perfect.
Okay, all in favor?
Aye.
Aye.
Opposed? Okay, that's added under 4C. Oh, and so we're on to public comment. Is there any public? I don't believe there is any public here, but I'll just say it anyway. Is there any public that would like to comment? None, seeing none. That brings us to communication on 4A, Mission Square Retirement, formerly IMCA-RC trading process changes. You got in your documents the IMCA investment change. I guess it's a statement for Mission Square. I don't know if anybody had any questions about that or if anybody had any comments they'd like to make on it.
Bert's going to talk about it for us.
Okay, Bert.
Okay, thanks. Just confirm that everyone can hear me.
Yep.
Yep.
Okay. If everyone, I don't know if everyone received it, they sent out a two-page form which goes over the changes, and essentially the changes going from omnibus accounts to plan level structures for their plans. And I think the basic idea is that in omnibus accounts, you're going to have everything held together, for fund companies on a group level. And so, there you could be sharing the same trading going through with another town, and the town of Vernon and so forth. They have theirs with ICMA. It'll all would be done as a whole. Going forward, it's going to be done on sort of what they call plan level accounts. And so, that's, the thing that's sent out, it goes over what is changing. And that's essentially what's changing. Omnibus to plan level accounts. When it's going to change, they don't really give you much of a chance for any input. I sent this letter out in December, and the process was initiated, it sounds like in August, and finished across the board in mid-December of this past year. So everything has happened. Amy actually did receive one statement from one of the fund companies about trades that were made. And so that's what you're going to see every so often. You're going to see this. It explains sort of quickly why this change is occurring, not with much clarity, but the basic thing they're saying for better efficiencies regard to audits, due diligence, and electronic delivery of communications. And I think the bigger point is transparency. I think at some point, I was just actually reading today, the state of Texas, sort of objecting to one of the larger fund companies, BlackRock, in terms of some of the political views that their CEO, Larry Fink, was sort of espousing. And so they wanted to block his ability to vote their shares. I don't know if this is directly because of that, but I think that is for someone who's looking for, a reason why this is why, Mission Square is looking to do something like this. I think it's probably going to be down the road that rather than giving all the voting rights to fund companies, giving it the ability for groups to vote their shares on a lower individual level, that ultimately may be the goal. But going forward, for the participants, they won't really notice anything. The only thing that, from my mind, that you'll start to see is Amy might receive a statement from a fund company directly going forward. I don't think it's going to be, hopefully she's not swamped by this, but she may see something occasionally. Any questions?
Does it cost us anything to migrate to this?
No, nope. It's there's no fees associated with it. And you didn't have a choice, essentially, either.
Well, the choice would be to move, but I don't want to do that.
Anything more on that? And that brings us to 4B, the 401 DC plan doc restatement, which was an email, I think, to Amy. She copied me on, and let me just pull that up. So it looks
So
like
the
Amy.
answer,
Go
well, we
ahead.
got our answer back. Our answer back is that we are a canned plan. We did not do a independent one. So I guess the only thing we'll have to do is accept theirs, but I still think we probably have to have George read it before we accept it.
Okay, and then who accepts that? Is that you or the first?
I'm thinking you guys and then the Board of Selectmen, because that's how we did the original adoptions.
Gotcha. Yep. Okay, so more to come on that then?
Yep.
So that brings us now to 5A, new business, the pension fund update by Webster Bank.
You're not gonna do 4C?
Oh, I didn't write it down on my thing. Thank you. Yeah, okay, so 4C is, I guess we should share this. I don't know if I have sharing capability or not.
Give me a second. There you go.
Can everybody see that?
Yep.
Yes.
Yeah, okay, so you can kind of read this, but it is just going over what our valuation was and what they think we're going to have to end up budgeting for our contribution this year. As you can see, in 2020, it was almost 1.5 million. It's just a little bit lower at 1.422 this year. So I just wanted to bring that up for everybody to take a look at. Maybe Amy, you could just, or I could send it out to everybody that in the group, just so you have a copy of that for yourselves.
I can send it out. I'm sorry I didn't. I think I meant to and I just got busy. But basically what they said is because it's going down, instead of taking that as a budget reduction, a lot of towns have been reducing their interest rate again. And we just finished moving to 6.25, because remember we went from 6.5 to 6.375 and now to 6.25. So that is actually their recommendation, is that we should consider lowering our interest rate again. So
So
I
what,
guess
6
it's-
even, or?
They didn't say, they just said that we should consider that because it was such a good year with investment returns to, instead of reducing the budget, put more money back into it. So I guess my next steps would be, if you guys tell me you want them to rerun it with 6 to compare so we can see the difference. They do still have a couple open Board of Ed questions on our census. So I think there's a note in the email that came with this that says that they're still using 2020 information because they still have questions on the 2021. So that may change it a little bit anyhow. But I think if you guys give us the direction to at least find out what that number would be, that I could reach out to them and get them a pro forma with that number.
Amy, we went from 6.35, did you say, down to 6.25?
No, we went from 6.5 to 6.375 to
Yeah.
6.25 because they wanted us to go the whole 0.25%, but it was a big number. It was like $75,000
Yeah,
each of those halves. So we only did half and half. So it took us 2 years to get the last 0.25% that they wanted.
so do we want to look at doing that again as opposed to taking the full leap of a full quarter?
I
Is
guess
it-
it really just depends what that number is.
Yeah.
It'll
How
also
difficult
depe-
would it be
it'll also
for them
depend
to
on-
run it? How difficult would it be for them to run it at 6 and 6.125?
I'm sure they could.
Yeah, so I mean, if you could get that, that'd be probably more helpful than just the full leap.
Is everybody okay with that? Is that an agreement, a motion?
What did you have to say about that, Jason?
I was gonna say, Amy and I have not started putting the budget together yet. That's actually on tomorrow's to-do list. And the numbers so far suck. So I would really like to be able to use that extra $75,000 if that was on the table.
Well, only about a third of it's ours. The other
I'm sure
half's
Patrick
mine.
could use it too.
Yeah.
That's what kind of where I was leaning was, taking a break for a year from, our interest rate assumption changes. Kind of pocket that. I mean, we're at 80, almost 85% funded, and then, look at it again next year. But it depends again on where we stand with other things in the budget. If it sounds like it's not so good, then we could definitely use a little bit of money.
Oh, there's always more things in the budget than the money is available for them. But I think the 6.25 is a perfectly fine interest rate assumption. it's not like we're out of the ballpark. We're probably on the low side if you put all the plans together. So I would not be concerned if we left it at 6.25.
Anybody else?
I'm with Amy. I'd be fine at 6.25.
I'd like to see what the lower numbers look like. Just, if they could run it, if it's not gonna cost us anything.
It's gonna cost.
Yeah. Is it an exorbitant amount?
I don't know.
No.
Hey, do you know?
They cost more than Josh.
No, it did.
They bill out on like a $500 an hour basis, whereas the town attorney bills out at $335.
Personally, I'm with kind of the crowd on this. Like I said, I'm fine where we're at. I don't think we could take a break from changing that assumption.
Just a clarification, question for myself. When you say it costs them to run the numbers, like just to run the numbers, there's a cost?
Yeah, and
Yes.
it gets paid for out of the fund.
Gotcha.
Just like they charge us for every pension calculation that we do. I get a bill every quarter for all the things they've processed.
Okay. It's just crazy.
And
We're in
Pat,
the wrong business.
the kicker is they're actuaries. You won't know if they were right or wrong for 70 years. It's a hilarious gig.
Yeah, but it's hard to do. So whether they're right or wrong, you got to get paid for it. All right. So do we need to make a motion on this, or are we just going to let sleeping dogs lie?
I just a consensus of what you guys are thinking. Just leave it at 6.25. Don't bother to have them run it.
I think
We'll
it's
just take it as it is.
majority of us. Yeah. So
Okay.
Fran, you okay with that? Because you were the one.
I'm all right with that. I thought that Jason was looking for the cash if we ran it lower. So. and
Oh,
I-
no, wait a minute. No, it goes the other way.
No,
Yeah,
we go
if
lower.
you go
it
higher, I
costs
get more cash. Lower takes it away.
Oh, all right, sorry. No, I'm
yeah, we
good.
can make it real easy by just saying, oh, we're going to assume we're going to make 10%, and then we'd have a lot of money.
Okay.
Last year we did.
All right. So I guess that's enough on that. So that dispenses with 4C.
Thank you.
Okay, so now we're on to new business. 5A, pension fund update by Webster Bank, for real this time.
All right. Well, thank you. And sorry, we have to do the Zoom again. So hopefully it'll be short-lived and we can get back together. It was nice to get away from the dining room table for a little while. So you can see, I did notice, I have to apologize, there's no page numbers on my report. So
There
if
is
you
on the
have the
PDF, Bob.
report,
Bob, there is on.
yeah,
PDF.
so, yeah, let's go to page 3 on the PDF. That's our typical recap of, the quarter, our thoughts on where we think we're going, at least for in the near term, for 3, 6, 9 months. So let me start by saying, as you can see, it was a banner year in the U.S. equity markets, not so in the fixed income markets, which were down slightly, but the S&P was up 28.71%, nearly 29%. So it was a pretty good year, certainly on a relative basis, and on an absolute basis, that's a really good return. And that was on a backdrop of improving economic fundamentals and consumer optimism. Despite all the concerns we had with COVID, we had a couple of bouts, if you recall, in the end of August. We had the Delta variant that kind of bled into September and ruined that quarter end, if I recall correctly. And then again, in December, and that continues to, I guess, rage on. So, they claim it's not as deadly, but from what I'm hearing recently, looks like hospitalizations are up and deaths are up as well. So, we'll see. And inflation continues to be an issue. It's more persistent than, the Fed had been thinking, and the fear was that inflation would become embedded in some items, like housing costs, for instance, or rents, which is a big component of the CPI. So we've seen that, and that's got the market a little skittish, as you see. Certainly today, the S&P was down nearly 2%. The Russell was down 3%. So even though we still had really, really good returns, and we still feel pretty optimistic about 2022, there certainly are some concerns out there related to inflation and how the Fed's reaction is going to be. And I think you're seeing that play out in the markets right now. But we do believe that there will be improvement in the supply chain issues, continued consumer demand for goods and services. We believe that all of that will support business growth, and ultimately we'll see that in earnings. And if we see good earnings, we usually see good returns in the equity market. So that said, again, headwinds are present. The Fed's actions will be monitored very closely. Concerns over the velocity of the balance sheet reductions, which were somewhat of a surprise. I think we talked about peeling back some of the purchases. There certainly was discussion about interest rate hikes, but that let's reduce the balance sheet item, I think, was something that caught some folks off guard there. And now, given inflation and COVID-induced labor shortage and so forth, the issue is how many interest rate hikes. 90% chance right now, the guess is that there will be 4. So we'll see. Others say that there will be more. Others say there will be less. And what will be the velocity of the balance sheet reductions, and when are they going to start? We keep hearing March. Is that going to happen? Is it going to be postponed? So there's a lot of uncertainty, and I know we've used that word before, and usually when we have uncertainty, we get a lot of volatility in the markets, and we're certainly have been seeing that over the last few trading days. So where we remain in the near term is, I've used this before, cautiously optimistic. Employment numbers look good. The consumer appears to be ready to spend. Yes, there's inflation. We've seen some wage growth, though. Hours worked are up. I've mentioned that to you before. So we have something that's mitigating some of these higher prices, but they are certainly more persistent, and it can change attitudes. So it's kind of a wait and see what happens. And then, of course, we're trying to digest exactly where we think the Fed is going to come in with respect to these balance sheet reductions and the interest rate hikes. So we need more information. So it could be a little choppy, is what I'm saying. But I think overall, at least right now, our view is that 2022 will be a good year. I'm not sure we're going to see 29% returns in the U.S. equity markets. That would be nice. We're certainly not expecting that. So we will see. But we do believe that it should be a good, at least first half of 2022, really cautioned with how the Fed reacts, how quickly, and COVID, which is something we just don't know. So with that, why don't I, unless I have any questions at all from anybody, hopefully that helps a little bit get a sense of what we're thinking. Why don't I send it off to Bob? He can go through the asset allocation, the flows. We can go through the performance. And of course, if you have any questions, please ask us. Bob?
Thanks, Bob. Yep, thank you very much. And if you can go to page 5 of the PDF, we'll start with the overall asset allocation of the portfolio. So the top left will show you that we continue to overweight equities. We're at 66% versus the target of 60. Fixed income, we continue to underweight fixed income. We're roughly at 32% versus the target of 40. And we have 2% in cash. We continue to overweight equities for several reasons. One is financial conditions continue to remain easy. The Fed is being very accommodative. If you look at global bond yields, they are negative when you factor in inflation, which is a positive for risk assets being equities. And just a third point, credit spreads remain tight. So if you look at credit spreads, which are the difference between high yield bonds and government bonds, you're not really getting paid to take that extra risk in high yield bonds. And what that typically means is the economy is on solid footing and we're not really as close to a recession as some people might think. Why we are underweight fixed income right now, several reasons are, as Bob pointed out, inflation has remained higher for longer than the Fed had anticipated. And most of that is to supply chain issues from Omicron. And the Fed really doesn't have any tools to fight that at the moment. The Fed is going to be, has indicated that they're going to be raising rates this year, which would drive rates higher, obviously, and prices down on bonds, which is negative for fixed income. And then the third thing is with quantitative easing slowing, the slowdown of the bond purchases by the Fed, that should also increase interest rates, which is negative for fixed income. Any questions on the overall asset allocation before we get into the flows on the bottom right? Okay, on the bottom right, you can see year to date where we started and where we ended as of 12/31. So I won't read all the numbers, but we started with a little over $33 million. And after the contributions, withdrawals, income, fees, and market appreciation, we ended with $39,466,000 for almost a total return of 15% for the year. So to Bob's point, the S&P was up 28.7%. Very good year for the overall market. Fixed income was negative. So by overweighting equities versus fixed income, it was a good call by us. Any questions at all on that page? Okay, if not, we can go to page 6. We'll just show you quarter by quarter the asset allocation, excuse me, and any changes that have happened. If we could focus on the last two columns, you'll look at Q3 of 2021 and Q4 of 2021. And the top line there, the US large cap, it went from, 54.5% to 57.2. A lot of that, or most of that, was the market push in the fourth quarter of 21. The S&P was up a little over 11% for the quarter. Another change on the equity side, you'll see the international emerging markets. It went from 4.5 in Q3 to 3% in Q4. That was due to I sold about $500,000 of the Matthews Asia Pacific Fund, mainly just out of concerns with China over the overregulation, the tightening on lending standards, and then just some of the concerns over the real estate in China. So we pulled back the exposure there. And then on the fixed income side, you can see the Q3, the government credit was at 29.4, and it went up to 30.0. And that was, I added Treasury inflation protected securities to the portfolio. Just with inflation continuing to be a burden on the market, I thought it would be a good time to just get a little bit more defensive on the credit side. So I did that as well. And then everything else had stayed the same between Q3 and Q4 in the portfolio, other than I used a little bit of cash to purchase the Treasury inflation protected securities. Excuse me. Any questions on that page at all?
So I didn't catch what you used the cash for?
To buy the Treasury inflation protected securities.
Okay, gotcha.
If you,
So it was added to the. Go ahead.
when I look at Q1, Q2, Q3, Q4 in the cash department, Q1, we had 1.7 million. Q2, we had 850,000, then 1.5 million, and then 880. Is there a bounce there? Why does that number bounce the way it did? Like every other quarter, it's bouncing back up to where it was.
Yeah, I don't have it in front of me, but I believe it's the contributions.
That's what I'm thinking.
So
I'm thinking
Yeah,
we didn't give
Yeah, the
last
town
year's
makes
until
its contribution.
January or late December. So
Ah,
that ended up in Q1. And
Yeah,
then this
okay.
year, I made a point because Milliman actually does our valuation, assuming that we make our contributions in the beginning of the year. So I made
Mhm.
sure that the contribution was made in July or August. So that would be the Q3.
Yeah.
And you'll see in
Right.
that page before, the contributions were like $3 million. So that's basically 2 years worth of contributions that fell into one calendar year.
Right, because you're fiscal, yeah, and this is a calendar year report, so we're grabbing it. And when you look at it, that 3 million, 2.9 million was employer contributions. The other 350,000 was employee pre-tax contributions that come in with each pay period. So that's what it is, Ed. The money comes in. Of course, employer contributions are significant, and then Bob takes that and averages those dollars into the market.
Okay.
If we go into the holdings, which start on page 7, the only change that we had as far as active managers is I sold the JP Morgan small cap equity, which is the third manager down on the sheet. You'll see it's netted out at 0. And all I did is I did some passive investing. I wanted to stay in small caps. I just thought with the increasing wages and the continuation of inflation, that it would be a little bit harder for small cap managers to outperform in this type of environment. So I would rather just have the index for now. But I wanted to keep the exposure to small caps overall. So I just rotated out of the manager and into the index. Other than that, all of the managers that we have were the ones we had before, and there have been no changes on any managers or any indexes inside the portfolio. On page 9, we can look at the performance. And there's a lot of numbers on this page, but if we focus on the top line first, that would be great. We can look at the total portfolio versus the blended benchmark, and that blended benchmark is indicated in the footnote down below. But the total portfolio for the 1 year, like I said, was 14.97 versus the blended benchmark of 1398. And then you can see the 3 and 5 year are outperforming the blended benchmark slightly. We're at 1633 versus 1615 and 11.89 versus 1168. And then since inception, the portfolio is up over 10% per year since inception. So just even on a 5-year basis, it's an annualized number. So for each of the last 5 years, we've done almost 12% in the portfolio. If you break it down further, you can see equities are the main driver of the double-digit returns. Even the S&P 500 for the last 5 years has done 18.47%. Our domestic equities, which is contains large, mid, and small, was up 18.44 for the 5 years. And then our international equities, 10.07 versus the MSCI EFA of 9.55. And then fixed income, 2.22 versus 2.91. And why we always try to keep a little bit under 5% in cash at the moment, just you're not getting paid to hold any cash. So we just think there's other opportunities in the market where we can get some income and some possible growth in the market as well. Any questions at all on the performance overall?
You guys smoked it last year.
Yeah, nice job.
Oh, thanks. It was a very good year. And, overweighting the large cap spaces versus international was a good call. And then fixed income, just taking a little bit more credit exposure and a little less duration in the portfolio actually helped as well. And we continue to believe, Bob pointed this out on the page 3, we continue to believe that equities are going to outperform fixed income. And with interest rates on the rise this year, we're anticipating a flat to negative on the fixed income side. So a continuous overweight there is going to happen for the year of 2022. But if there aren't any questions on,
I just wanted to add that the blended that's our new blended benchmark. So it went into effect on 10/1. So the way the blended benchmark is, well, you can see the components of it now. So it's more expanded, right? More diversified, which is where we wanted to go with it. So the 3-month number is 100% of that benchmark, where the 1 year, the 3, 5, I can't see without my glasses on, inception, blend the blend, if you so to speak. So we had the older benchmark, and then we have 1/4 of the new benchmark. So, over time, it will become 100%, except for the inception column. But I just wanted you to point out all that hard work we did together on the IPS and develop the new blend benchmark. It is now effective.
Thank you.
Bob. And if you want to go to page 14, we can look at the OPEB. And it's basically the same story as the pension. We are overweight equities, underweight fixed, all for the same reasons. And you can see down below, we had a total return of 15.68 year to date. And just the reason for the slight outperformance on the OPEB versus the pension is just it had a lower exposure to emerging markets and a higher exposure to large cap, and that helped for the year. And then just on page 17, we'll show you the overall performance of the OPEB since inception. And to Bob's point, we did some work on the IPS to finally get a blended benchmark for the OPEB, and that's why it's only showing under the 3-month number. And then as time goes on, that number will fill in the different time frames. Any questions on any of the numbers?
Yeah, I have one.
Sure.
We can go with the OPEB benefit on the first page. What page is that? What page? 14.
That would be 14.
Yep, it says withdrawals, $29,000. It also shows cash held, $38,000. When you make a withdrawal, do you hunt down the least damaging asset allocation to take the money from? Because it would seem to me that the money sitting in cash is earning us nothing. If I was making a call here, and I'm not telling you how to do your job, but if it was my call, I'd be taking that 29,000 out of the 38 and let the rest of the stuff run.
Sure, but again, with the IPS, the maximum I can be is at 70% in equities. So we're at 67.6, and I do like to have some cash on hand for any time that we could possibly buy a dip in the market, which we're starting to see right now.
Yeah.
So as painful it is to say you're earning nothing, it does give us some buying opportunity as well without possibly selling an asset that I don't want to sell because I think it still has growth prospects.
Okay, yeah, I forgot about the restrictions.
Yeah. So you have the overall band. So whenever you do make a move like that, then you have to be aware of the impact to the fixed and the equity. And we use cash tactically, as Bob mentioned too. So a little dry powder if there's an opportunity, and we really don't want to sell anything, but we want to buy or increase a position. So we have it.
Yep.
I don't have anything else unless there's any more questions or concerns. Bob, do you have anything at all?
No, I just wanted to point out, that we got the IPS effective. You see that in the blended benchmark. So again, thanks everyone for all the work we did on that, George included. I'm glad it was, it was a great year. We had a great run in the equity markets. We certainly took advantage of that with our asset allocation in the portfolio, overweighting equities, in particular U.S. equities. So that's garnered a lot of additional incremental return. So that worked out well. 2022, like any other year, is let's see what happens. We feel pretty good about it. But there certainly are some headwinds, and there's some things that are completely out of our control, like COVID. And every time COVID comes up, it disrupts the supply chains, and it disrupts consumer activity, which decreases business activity, and hurts earnings. So, there's always headwinds. It's no different than any other year. They're different ones, or maybe some of the same host of characters that, depends on which one is most prevalent at the time. So, but we'll continue to be all hands on deck, and, we'll see, how it goes with the Fed. So we'll start with there, and I'm hoping that the COVID outbreak is controlled soon. But other than that, I think, sorry?
I'm sorry. What do you think about the emerging market in international stuff? Do you think that that's over, or do you think you're maybe going to pull some more out of that? I mean, do you think that China, like evergreen, is settled at this point in time, or is there more to come on that? It seems to me like it's not settled, and China itself is what the GDP is slowing.
Yeah, that's a great question.
Yeah.
Go ahead, Bob. We were looking at that as a group today. I'll be reducing the emerging market exposure. We were just hoping that we would be coming out of COVID a little bit better, and we didn't anticipate the real estate problems in China. And so I'll be reducing that and adding to the US. Emerging markets not in our benchmark right now. So it doesn't make sense to have it at this point. It's just taking on additional risk that I don't think is necessary. So it's a great question, and yes, I will be removing the emerging markets and adding more to domestic.
When do you think that inflation becomes an issue? I mean, like you guys said, from my point of view, and I'm not an investment guy at all, but it seems like you just, everything's going to be volatile. We're going to be buying dips. It's just money moves from one side to a different side and then keeps growing, right? So, but is there a point where it starts to really hurt us, and we change what we're doing? But I guess there's not much else we could do, is there?
Yeah, I don't know if everybody's seen the acronym PINA. It's really, there is no other alternative other than equities at the moment. And it's just trying to find the safest space in the equity space. Fixed income looks like I said, will be negative to nearly flat for the year. If we start seeing inflation spike to double digits for a lot longer and we see another variant come on board, the best we could do is just reduce the overall equity exposure and sit on cash until we think those concerns are behind us, and then try buying back into the market at a better point.
Thanks. Anybody else? Okay, so then we'll move on to new business, 5B, the 401S and 457B investment analysis. It's Bert.
Okay.
Thanks,
and
guys.
so,
Sorry.
and I think I've said this a couple times before in previous calls. It's always interesting to sort of transition from the two Bobs to me, because what they're doing is much more tactical. They're trying to anticipate and sort of do minimize volatility and maximize return. Our role here, my role here, is significantly different. We're not trying to anticipate anything. We're just trying to look at what the options offered in these plans have done, and making sure that they're still prudent options for the plan participants. In saying that, is, I don't want to put the cart ahead of the horse, is that, if we look at item 6A, 6A is the approval of the investment policy statement for these two plans. And so I think the next time that we meet, there might be some more some concrete ideas that will come out of this. But if I don't know if you want to pull up the attachment that I had sent over, Amy. But what we provide on a quarterly basis is an investment review of the investment options and how it's defined and analyzed is that we have a 12-point scoring system. We're looking at issues in terms of performance, how a fund is handling the volatility, the manager's ability to provide return, looking at the fees relative to their peers, and actual manager tenure. So if we're trying to attribute performance of a 3 and 5 year period, we want to make sure that that manager's actually there. Overall, big picture, if we look at page 3, and if you went on to page 4, and it goes on to page 5, the snapshot, you'll see mostly green. The performance of the funds continues to be pretty strong. We have 2 options that we had mentioned previously that we have our eyes on in large cap growth, prime cap Odyssey growth, and in small cap value, the LSV small cap value institutional fund. In both cases, one, because we have not approved the investment policy statement, I am going to recommend that we just maintain for the one more quarter at least. I will email Amy some points that she can keep for the notes as to why we should maintain these options. But by clear definition of how the investment policy statement works, if a fund is not passing 4 consecutive quarters or more, we do want to take a deep look at why it's not passing. And you'll see that both are actually extended out to 8 quarters at this point. You'll also notice that American Funds Fundamental Investors in the large cap blend category has now dipped down to a 6, just 1 point below not passing for 3 consecutive quarters. Similarly, as we enter next quarter, it may be a fund that we take a sort of harder look at. But breaking it down in terms of saying, okay, why should we not be making any changes? The Prime Cap Odyssey Growth Fund is a fund that's been around for a long time. And when you maybe listen to sort of the 2 Bobs, analysis as to how they're creating allocations, the large cap area has done very well. Relatively, if you look at the fund, I think it was up, close to 20% last year. It's close to 20% over a 3-year, and almost 17% for a 5-year. So, from an absolute basis, everyone would be thrilled to have that type of return. But relative to its peers, it's underperformed. But it's not sort of what we would think of as a pure growthy fund where they're investing in some of the larger, names that the Alphabets, the Apples, the Facebooks of the world. They're sort of picking and choosing some smaller names, but still fitting in that large category. They don't really sort of fit purely in that, but it's been long-term. It's been a great fund. The managers, for the most part, have been there for over 15 years. And if we look, very, very micro on the year-to-date in what we've started to see in a down market year-to-date, it's performed very well. And so we've gone through a period of, essentially, 10 plus years of up markets in within that, some very strong markets. It may prove to be a fund that has some downside protection for the participants who are in that. Again, they've seen strong returns, but in a short, period that where we have seen the volatility, you tend to see less, downside than some of the other funds. The second fund is the LSV small cap value. This is sort of the easier fund option to look at and say, we really may want to maintain it. Last year, if you look at, I'll look at it, just bear with me for a moment, on page 7 of 13, if you look there, the 1-year number, and I don't, yes, you're there. The 1-year number you'll see was up 34.5%, very strong. That's probably the strongest performing fund in all of the options. That's in part because large small cap value was a strong sector to be in. But if you notice, below its peer group was up 31% last year. And the index associated it was only up 28%. So it was significantly outperforming not only its peers, but its index in the 32nd percentile. Again, in these cases, the lower that number, the better. And if we look year to date at its performance, again, a very small sampling, but it's outperformed its peers. And similarly, when we look at, sort of the opposite, the large growth, where we've seen huge return numbers over the long term, the small value has been an area where you've seen probably in the 5 and 10 year, sort of some of the weakest performance, just because, outside of this past year, just because it's just hasn't been in favor. And so some of its returns in some of the years where not being a pure small value fund has hurt it. And so when we've seen the years where this fund in small cap value has performed well, it has shined. And so again, those are the two funds that, assuming as part of 6A that we do approve that, we'll probably take a hard look at that next quarter. But for the short term, I think there's more than enough reasons to, when we look at those two funds, to maintain it. Again, I'll email Amy some bullet points as to why we should be doing that. And she can certainly share that with everyone here. But essentially, verbally, that's pretty close to as to what I'm going to be sending. And that being said, does anyone have any questions just on the overall scoring, or if you take a look at some of the performance numbers, do you have any questions? Okay, can you still hear me?
Yep, we can hear you.
Yes.
No
Okay,
question.
Okay, so that's good. And so again, when you'll start to become a little bit more comfortable with this, and especially when we're doing this in person, it'll become a lot easier just to look through these numbers, and I'll sort of go into some greater detail in future meetings. But I think for the purposes maybe of today, just again hitting the highlight, and again, when the investment policy statements approved, we'll really start to live by that document, and as a result, maybe make some changes to the plan.
Okay, anybody else got any questions or comments?
I'm good, thank you.
Thanks, Bert.
Thank you.
Bert, the only question on the next item on 6A is, I think we were waiting for you to get some kind of approval
Oh,
for
okay.
the plan.
Yeah, no, I thought I had sent this. It was, and I'm not going to be able to bring it up right now, but it was what I was told on my end was that it's the edits, they can't say yes to the edits. But in its shape and form, everything was fine in terms of, having the plan sort of run off of that investment policy statements, meaning the legal department at LPL, our RIA, it just doesn't approve every changes that are done, but as long as it's, approved from your end, and it's not changing the scoring in any of the measures as to how we're gonna do the investment policy statement, they were fine with it. And I'll send that along to as part of the follow-up.
So they're not going to approve everything, but they don't disapprove of anything.
Exactly. I guess that's probably the best way to put it. Just because, and all of the changes that were made were just making it more specific, saying the town of East Windsor versus the plan sponsor. And it's, I don't want to say they're entirely official. I think it added clarity, but nothing that was added was saying that the scoring system should change, the metrics as to how we're coming at that scoring would change. And so to your point, that's exactly how they looked at it.
Okay. So I guess that we'll be looking at the next meeting to approve that document then. Well, that brings us to the end of our agenda. If unless there's anything else on the IPS for old business, I think we'll be approving that next time. Thank you, Robert and Bert, for all your input. And I would entertain a motion to adjourn.
I move we.
Right.
Fran, that's you.
Well, thank you.
I did. Nobody heard me, I guess. I move we adjourn.
I second. the
Sound like you cut out.
All right, so it looks like we have a motion by Fran and a second by Ed to adjourn.
Correct.
All in favor?
Aye.
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 All right, that'll do it.
Thanks, everyone.
Thank you.